Good morning, afternoon, and evening. Welcoming you from wherever you are at this moment. I am Wendy McGeehan, Senior Director of General Management, Business Acumen Open Enrollment Programs at Wharton Executive Education. And I am so happy to have so many of you join us as we take the time to explore a topic area that continues to be extremely relevant to so many people in so many different ways. But before we dive into our session this morning with Joao and Nick, I want to address a few concert rules or guidelines to make your experience with us a success. We will be taking questions throughout the discussion, so please use the Q&A icon on the right side of the screen to post questions. If you have technical issues, please use the moderator chat function on the right side of the screen to submit your tech issues. And now please let me introduce our faculty. Joao Gomez is the Howard Butcher III Professor and the current chair of the Finance Department at the Wharton School. Joao is a long-standing member of what we rightfully feel is the best macro capital market research group in the world and a veteran of many of our executive education programs. Nick Rusinoff is the Moisey Y. Safra Professor of Finance and head of our brand new quantitative finance programs at Wharton. Starting this June, Nick is also frontlining our new Wharton on the Markets live series, which we will discuss more at the end of the program. Professors, the floor is yours.
Very much, Wendy. Hello, everyone. Thank you for joining us today. I hope you're all well and healthy, wherever you are in the world. Nick, COVID-19 and our aggressive policy reactions to it have upended the economy and pretty much all of our lives. So much has changed since early March. It's hard to even know where to begin this discussion. How would you start?
Wow. Well, first of all, good morning, everyone, and thank you, Wendy, for the introduction. Wow. Well, I would start where I think all investors who have been following what has been happening to their portfolios over the last 3 months would have probably looked at first, which is what has been happening to the U.S. as well. Here, for now, I'm going to focus on the U.S. I'm showing the prices of the Russell 3000 index, kind of the broad U.S. stock market index, starting in February and up to the recent days. And of course, anybody who has been paying any attention, which is pretty much everybody, I think, who's here, has been seeing this as a kind of a stomach-churning ride of the markets from their peak in early February. Stock market lost about 36% of its value by the end of March, the bottom of it at March 23rd, which is kind of when the Fed and the U.S. government kind of aggressively intervened to try to prevent kind of the economic damage from the COVID-19 crisis to be as severe as it might be. And since then, as we've seen, more than half of that value that had been lost has recovered. And again, we're certainly not near the pre-coronavirus highs, but it's a much more kind of comfortable position from the standpoint of valuation than a couple of months ago. Now, as financial economists, we want to understand, before we can kind of talk about where do we go from here, we want to understand what happened and kind of how can we explain the really kind of dramatic event from the standpoint of financial markets. Now, of course, prices of financial assets reflect kind of two things. They reflect expectations of future cash flows and discount rates that investors use implicitly or explicitly to discount those future cash flows. So we'll look at expectations. Of course, we don't observe expectations directly, but we can go to equity analysts to see what their forecasts tell us about what investors can expect about the future earnings of U.S. corporations. Here, this is the 1,000 largest firms by market capitalization. You see a rather dramatic decline, but it happened in a very, very different fashion from what we just saw in the equity market pricing. where the adjustment of analysts' forecasts was rather gradual throughout February and March, and only started accelerating downward in mid-March or so, continuing pretty much up to this day. Now, what you see that there is indeed a dramatic revision ultimately of forecasts from being rather optimistic in February of about 12-13% annual growth of earnings next year and year after and so on, down to a negative 5% growth for the earnings growth until the end of 2020. What you also see, however, is that these downward revisions are not nearly as dramatic for earnings growth 1 year, 2 years, 3 years out. So while there has been a decline, this decline has been much less dramatic. So analysts still expect a reversion to the mean and ultimately positive earnings growth from year 2021 and further on. Now, this is actually quite puzzling if we want to reconcile this with the prices and the behavior of prices that we had observed, because the bulk of the value of the U.S. equity market is in the years after 2020, after year 2021, and so on and so forth. So if analysts correctly forecast future earnings growth, then even given this somewhat dramatic decline, but still of only 5% of earnings growth for year 2020, how can we rationalize this sort of the stomach churning ride in the equity markets that we had seen? In fact, if we are going to use a constant discount rate to discount future earnings, and using these revisions that I just showed, we would see a very gradual decline of stock market prices throughout February and early March, maybe accelerating a little bit, and ultimately meeting basically at the same point as the equity valuations are by mid-May or so, but completely missing this dramatic roller coaster that we observed in March, April. So unless equity analysts are really wrong in updating their forecasts, something else has to be going on here. And again, as financial economists, we would interpret this as evidence of discount rates playing the biggest role. Now, of course, what are discount rates? The discount rates consist of a component that discounts for time value of money or risk-free interest rates, and those, of course, we know had also gone down during this period. But it also consists of the risk premium component, the component that compensates investors for bearing the risk in the stock market, and that itself consists of both the amount of uncertainty that investors face and the price, the compensation that they demand for bearing that uncertainty. Now, of course, we don't observe those things directly either, but what we do observe is the option implied volatility. This is the VIX index from Chicago Board of Options Exchange. There's this blue line here that I'm superimposing on the Russell 3000 index, and you can see that these two lines are almost mirror images of each other. So this VIX index, which people call the fear gauge, is effectively a measure of how much investors are willing to pay for protection against kind of outsized moves, especially downward moves in the S&P 500 in the options market. And it tells you that the fear that investors experience, probably the combination of the amount of uncertainty of how bad is this event going to be for the stock market, as well as potentially kind of the fear of that uncertainty was quite dramatic, again, peaking right there in the middle of March when the stock market saw its bottom. And then as that fear receded, again, following the aggressive government action in particular, the stock market has recovered up to the current level.
It's interesting that you mentioned volatility, because perhaps the most striking aspect about all of this to me has been the enormous daily volatility in asset prices that you just showed us. You also teach behavioral finance for us, so you're sort of the perfect person for me to ask this question. How much of what we have seen do you think was driven by just purely rational investor behavior versus what you might just call fear or animal spirits?
That's a very good question. And of course, yes, I've been teaching behavioral finance, and my students have asked the same question over the few months. We switched to teaching online, of course, after spring break, and all of these issues have been very much at the forefront of our discussion. And absolutely, you can interpret this dramatic fear also reflected in this VIX index as a sign of, well, a panic. I mean, you can't describe what we saw as a panic, and certainly the volatility where you see 3% or 4% daily moves on barely significant news as kind of a sign of overreaction, maybe driven by, again, the sort of panic, fear, kind of emotional forces, which you can understand given the nature of this crisis. Also, of course, we're dealing with not just a regular recession. We're dealing with a pandemic where people actually are afraid for their own lives and lives of their loved ones, and so they may be kind of reacting much more emotionally to the news than they would otherwise. So that's certainly a possibility. I would go a little bit kind of maybe in between, though, the purely kind of animal spirits type explanation of this and a purely rational explanation of this, and say that it's perhaps not completely unreasonable for people to be highly uncertain about how this pandemic would affect the economy and how it would affect their stock portfolios, and so that fear maybe is not completely unjustified, or was not completely unjustified. And yes, analysts are predicting a very kind of a mild decline in earnings that will relatively quickly reverse. But ultimately, the risk that investors face might be concentrated in kind of some of the worst case scenarios rather than in the most likely or kind of average expected scenario. And investors might be particularly fearful of that low, kind of very persistent shock, or very slow subsequent growth, like we saw after the Great Recession. In fact, maybe the fear of the financial crisis was part of what was driving financial markets, and in fact, which is why things stabilized after the very aggressive action by the Federal Reserve, in particular, to prevent a kind of a repeat of a financial crisis, helped stabilize the markets and help them recover. So I would say certainly some behavioral forces here are playing the role, combined with the fact that ultimately we never know whether this time isn't going to be different. People always say this, but ultimately we have evidence from the past, and sometimes it doesn't seem very helpful for us to interpret the future. We have not seen a massive pandemic affecting the U.S. or Western Europe since 1918, and at that time the economy was very different. The shutdown policies that were implemented were much less severe, and so on and so forth. Mm-hmm. In addition, one more thing to add to that is that one argument that is sometimes made is that this particularly steep decline in asset valuations in March was in part driven by kind of, well, you could say technical features, but what I would say leverage constraints of leveraged financial institutions, such as hedge funds, who were forced to liquidate their positions as asset valuations declined. In addition to these volatility target strategies have become quite popular in the quantitative investing space, where as volatility increased, risk limits would be reduced, and the amount of leverage again would have to be reduced, forcing these institutions to sell into a falling market could have exacerbated the decline. But ultimately, something had to, I think, act as a backstop. And I think the combination of the aggressive actions by the Fed, the congressional action with the CARES Act, and I think ultimately, value investors stepping in and saying, okay, these valuations are really low, people are overreacting, this is time to buy. All of those things contributed to stabilizing the market and subsequent recovery, which is, of course, in part a behavioral explanation as well.
Thank you. Financial crisis. To me, these periods of crisis always bring to mind Tolstoy and his quote that while all happy families are alike, every unhappy family is unhappy in its own different way. What do you see as the key similarities and differences between this particular unhappy episode and, say, the great financial crisis of 2008 and past crises?
Great question. Of course, I love the quote. I could add to the little bit of ancient Greek. You don't walk into the same river twice. So, of course, this time is not the same as the last time. We had a financial crisis which didn't cause the recession, but certainly made it much more severe than it would otherwise be, and certainly had a much larger impact on the financial markets than the recession alone would have had. And perhaps again, this is a lesson well learned by the Federal Reserve. So even generals always are good at fighting the past war, but in this case, they sort of learned their lesson perhaps and acted aggressively and very quickly to do all they could really to prevent the financial crisis from taking hold. Now, in terms of the roots of the recession, of course, it's also very different because last time it originated in the household sector largely, in the housing sector and the mortgage kind of segment of finance, and unfolded from there. And so the impact the industry of various industries was quite different, because this time the recession is caused by something that is kind of outside of our kind of normal kind of range of shocks that affect consumers. This is not by itself kind of a shock that makes consumers fearful of spending money, unless of course they're afraid of their job. But a lot of people just cannot consume because we cannot go to restaurants, we cannot go on trips, and so on and so forth. So of course, sectors that in the past were in the previous recession in particular were the most affected, like sectors associated with construction, housing, furniture, there are other consumer durables and other capital goods. While they might be affected this time, they're certainly not the ones that are most affected. And even though energy and real estate are sectors that suffered in the previous recession and right now are also suffering perhaps the most, other sectors like consumer services, which were not nearly as badly affected last time, and travel, hotels, and so on, of course, cruise lines. These are the most affected sectors because of the nature of the shock that everybody now, of course, knows about. Now, about some potential similarities, though, in the previous recession and the financial crisis, what has been emphasized a lot is the role of leverage, right? The fact that households entered the recession with huge levels of debt relative to their assets, in part due to the housing boom and the extraction of home equity during that boom. And financial institutions were also quite leveraged. Now, while we have seen a ramp up in, say, cash out refinancing recently in the last couple of years as house prices have risen, this time households are not nearly as levered as they were in the previous recession. So while we might see some retrenchment in consumption due to kind of precautionary saving, we're not going to see a massive deleveraging of consumers as we did last time. However, this time it's the corporate sector that might be more of a worry. And in fact, again, if we see at stock price responses, the firms and industries that have been most affected are the ones that are most highly levered, and because they're the ones that are going to have the hardest time making it through the next few months when revenue is very low, and yet there are fixed liabilities that have to be made. And on top of that, financial engineering was blamed for partly financial crisis in the last recession, and we see glimpses of this also now. The recent bankruptcy of Hertz, which was, of course, driven not just by its high leverage, but also of how that leverage was implemented in the form of these variable leases where they were collateralized by cars whose value is now plunging because there's so many undriven cars that nobody wants to or can buy. And at the same time, of course, the payments on these variable leases have to reflect the value of the collateral. So as the value of the collateral falls, Hertz owed more money to their lenders, and this was something that was created in good times to optimize, of course, their cash flow, but it makes these firms that are highly levered in a particularly kind of clever way, particularly fragile in this type of environment. So this is something to watch out for. And finally, I think an important piece that hasn't been really discussed much is that what is going to happen in the long run? Will this recession just kind of happen and then go away and then we go back to normal? I think that's a lot of people, I think, hope for that. Well, in the last recession, the Great Recession, saw this jobless recovery that followed it. And part of the reason for this jobless recovery was the fact that the recession accelerated the trends in the labor markets that have been already ongoing due to, in particular, to technological progress in the shift from kind of labor-intensive production, let's say, to more technology and capital-intensive production due to automation, and kind of the skill towards sort of shift towards more skilled work and investment into these more technology and less labor-intensive modes of production. I think in this recession, we'll see the rise of, let's say, telecommuting and technology-enabled communication substituting for a lot of the activity that we normally do and that requires person-to-person communication and is supported by potentially large staff of not very highly skilled workers. I'm talking about, let's say, hotels and other kind of form of hospitality, transportation, and so on. Now that we're learning to make do without so much traveling, so much in-person communication, so much personal physical shopping or going to the store, it might accelerate this transition, and some of the jobs that are being lost in this recession might not come back, even when things go back to normal, or if things go back to normal. Just like the last recession, we saw this very slow recovery in jobs, unlike a very fast recovery in earnings that might speed things up. And this is just to show that the recovery in earnings was indeed quite steep at the end of financial crisis, even though we saw a very slow recovery of jobs.
And some of them are related to some of the things you already talked about, but I'm going to fit in a couple. Do you think that even though the market is bouncing back right now, do you think that once companies start reporting losses, we will have a cascading effect leading to a more prolonged recession? And related to that, do you think we will retest the lows of March in the coming months?
So in the slide that I just skipped, I was showing that the price earnings ratios of the U.S. stock market right now is at the level that was actually above that going into the Great Recession. And in the graph that I have on the screen right now, what I'm showing is analysts' forecasts of earnings growth in the past, over the past several decades, including several recessions, where we see that while on average the analysts' forecasts are about right, they tend to underestimate the severity of earnings drops in the recessions. And this is particularly for the 2000-2001 recession, and especially for the Great Recession. You see that there is barely any connection between what analysts forecast and how deep the recession actually was. There's always that possibility that the analysts might be wrong. They might be underestimating the severity of the hit that companies are going to take. And if we indeed see that, we could potentially see the stock market prices following where earnings are going, which is if they go much lower than analysts on average expect, then the prices are certainly going to go up. And now you see that analysts were right, as I said, in expecting a swift rebound in earnings after the Great Recession. But after the dot-com boom and recession of 2000, 2002, they were actually too optimistic. They expected that the earnings would rebound much quicker than they did. So there is that possibility, too, that we could see a more protracted recession, protracted slow kind of delay in the recovery of earnings. In particular, if we see that there's a second wave of the virus, right? The testing maybe is not as widely available as people hope. The vaccine doesn't arrive on time. So all of those unknowns, those things that investors might have feared in March, they're not completely gone. They're all there. They're all on the table. I think while we don't necessarily have the fear of a financial crisis yet, but all these other things that will weigh on corporate earnings are still within the range of possibility.
Okay, thank you. Let me just ask you a couple more quick questions. Smart or factor investing, that's strategies that tailor portfolio exposure to particular risk factors to try to outperform the market, it really crossed over in the last decade and became extremely popular. How did they fare during the last few months? Do you have any data on that to show us?
Right, so that's a very good question. So factor investing being the idea that there are sources of expected return in the cross-section of assets that are not perfectly correlated with these assets' exposures to aggregate risk from market data this idea has been around for quite a while, but it's been really popularized in the last decade. In the prior decades, it's been mostly to preserve, academics and some quant hedge funds. It's become democratized to the extent that the giants like BlackRock and Vanguard are offering versions of those strategies packaged in exchange-traded funds, and so widely available to investors. But the big question is, do these things actually work, and do they deliver value on average in the long run? But also, how do they behave in a recession? Because a lot of debate that is happening around factor investing. Is it really kind of a form of beta? Is it another compensation for risk, or is it simply kind of reflecting anomalies in financial markets due to kind of behavioral forces and mispriced assets? Well, what we see in the last few months, and what I'm going to show, is the kind of maybe canonical or academic version of the factors, which is a Fama-French factors. So, of course, Dean Fama, a Nobel laureate from the University of Chicago, who I had the honor of studying with, and Ken French, they were some of the pioneers of this idea of factors. And, of course, a lot of institutions implement different factors in different ways, but by and large, they're captured by these Fama-French factors and relying mostly on the idea of value, the value investing, that the value stocks that are cheap relative to their fundamentals, outperform on average. Small stock generally outperform on average, and recently there have been interest in profitability or quality and investment factors. Momentum has been also a very popular factor, and what we see is that over the last 3 months, some of the factors have done somewhat well. Momentum in particular has been relatively successful, at least on the year long basis, in even 3 months, last 3 months, although it didn't do well in April, but that kind of tends to happen to momentum when there's a recovery from a crash. But value has done extremely poorly. So the idea that Gene Fama has always promoted, that the reason value investing is profitable is because it exposes investors to risk potentially associated with a severe recession, here is actually bearing out. Now, of course, value hasn't done particularly well over the last decade, so investors actually hasn't seen that compensation for risk if they've only been doing value investing for the last decade. Again, it's supposed to be profitable in the long run, but it's not necessarily something that you will see on a 5 or 10 year basis. But what's interesting, though, I think one of the reasons the value is done so badly relative to growth is that because the bulk of the recovery in the market in the last few weeks has been driven by these extremely concentrated group of these big five. I like to call them Fama Five. I see other acronyms, of course, floating around, but this is the one to me sounds the best. Facebook, Amazon, Apple, Microsoft, and Alphabet or Google. Some of them have in fact barely even suffered in the March declines, and some of them have made kind of historical highs, like Apple, for example. And of course, these are growth names, and they're of course weighing on the value minus growth strategy, which goes along value firms and for growth firms. So part of that, the severe underperformance of value, it has been kind of the flip side of the coin. That we have seen that these technology firms are really benefited from the situation where we're all relying ultimately on technology to survive, to not just get our jobs done, but even to get our groceries. So maybe this is a peculiar situation, but maybe it's also a sign of the things to come, because also these firms will potentially lead to the kind of adaptation of the post-COVID firm. Facebook has announced that 50% of their employees might be working remotely going into the future, even when things open up. And this is not something that a lot of the maybe, again, value type firms are potentially very well positioned for. But again, this is something that in the long run remains to be seen.
Thank you. I think that's all we have time today for. I know you and I could continue to discuss this for a lot longer. We barely scratched the surface. Thank you very much, everybody who joined us. But in a sense, this is exactly the sort of session that you are planning to continue to do next month. If you haven't heard it before, next month, Wharton will launch 2 new live programs for finance professionals. Wharton on Financial Management, which is led by our friend, Professor Michael Roberts, and Nick Rosanov's very own series, Wharton on the Markets. So I wanted to use the last few minutes of this program just to talk a little bit more specifically about this. And you've been working on it really hard for a while. What's the idea behind this series, Nick?
Great. Thanks for introducing this. I think the idea behind the series is that, and I don't need to tell you that, and I think a lot of people in the audience know this as well, is that Wharton has perhaps one of the most famed groups of researchers in finance and macroeconomics and macrofinance. And this is a time that we share our knowledge with the broader public, and potentially in particular with investors who might seek kind of unbiased opinion and kind of insights from people who have been looking at the data basically for their entire careers, analyzing the history of the financial markets and the macroeconomy from the standpoint of different models and theories, trying to understand what drives markets, what drives the macroeconomy, and how we can position ourselves for the future, both in the near term and of course also in the long term. Now, of course, there's lots of content out there produced by various organizations, the great ones. I don't have to name the whole list, but from McKinsey to Goldman Sachs to BlackRock and so on and so forth. I think what makes our well, I don't want to call it product unique. I think our series unique is that we don't have a product to sell. Ultimately, our job as academics is to create and disseminate knowledge, and this is what this is about. We want to share the knowledge that we have created with the wider public. Of course, our working students, they get the benefit of this while they're there, but there is a lot more people out there who can benefit from this.
You and I have talked a lot about this series in recent weeks, and I've seen how much care you placed in developing and securing a lineup with so many talented colleagues that are right at the forefront of capital market research. Can you give us a sense of the format you have in mind for the program and some of the highlights we can really look forward to?
Right, of course. So the format will be a twice weekly lunch hour conversation, you can call it. Of course, lunch hour is because we're going to do it at noon and Eastern time. This is lunch hour for people on the East Coast, but it should also be relatively convenient for those as far west as, well, the West Coast. It's going to be in the morning, but reasonable, and even potentially to some of those in Europe who can tune in maybe around 6 or 7 o'clock. Depending on the time zone. for an hour-long conversation with one of the leading faculty members of our department in a particular area. And what I mean by the particular area is that there's a range of questions that some of them we touched upon, some of them we didn't get to, having to do with how will current situation affect this particular segment of the market. So we've talked about some of the industries that have been most affected, such as energy and real estate. We've talked about public equity markets and factor investing, and we'll delve more deeply into this and try to understand this question. Is value investing dead, for example? Is this democratization of factor investing kind of a good thing? Is it actually beneficial to investors? We haven't really gotten to talking about the bond market. Of course, anybody who has held U.S. treasuries, long-term treasuries, over the course of this this kind of violent period of the financial markets has done quite well, because the treasuries appreciated quite dramatically and so acted as a hedge against the decline in the stock market prices. Of course, this is in part kind of a flight to quality type phenomenon, but we see a kind of a prolonged decline in long-term treasury yields, and therefore an appreciation of bond prices, which suggests that investors do not fear inflation in particular, which is a little bit puzzling given that we are about to see $4 trillion deficits next year, according to CBO projections, kind of unheard of magnitudes, really. And a lot of people do think that this bodes ill for the future of inflation. So is the fiscal side of the stimulus, we can call it stimulus, we can call it just support for the economy, going to come with the cost of a huge monetary expansion? What does that mean for the bond markets going forward? Will the bond markets continue to provide a hedge? We will discuss that. There are markets that are a bit more opaque, that we don't see prices moving every day, like the private equity market, but of course it's also affected. So we want to understand that as well. And then there are some kind of undercurrents happening in the financial markets, like the transition from LIBOR, the most popular floating rate benchmark, to a new floating rate benchmark that's going to affect a range of markets, from corporate loans to student loans to mortgages and so on and so forth. That is also important for investors to understand. So we're going to have a great lineup of faculty. We'll feature some really famous, of course, people like Mohamed El-Erian and Jeremy Siegel will share their views and insights. With your help, hopefully, I will try to put these things together in hopefully coherent narrative that investors can really benefit from.
Yeah, I've seen the lineup, and we've talked about it, as I said, in each and every session. Just looks really amazing to me. I'd say there's very few silver linings about this crisis, but perhaps for educators and researchers like us, one of them is that we now have the opportunity and the technology to disseminate exciting new research ideas much more quickly and to a much larger audience. But to whom specifically do you think that this series will be of most value? Which types of professionals?
Anybody who supervises an investment portfolio in various capacities will benefit from this. I'm talking about high net worth individuals and their wealth advisors, multifamily offices, retirement advisors, and financial planners who are advising people on what to do with their financial portfolios going forward. Consultants who are advising retirement plans and pension plan sponsors, and also want to have a kind of an unbiased view of what the future might bode for them. But really, anybody whose job it is to understand what the markets are doing and how to plan for the future.
Thank you, Nick. I'll just conclude by saying, as chair of the finance department, I'm both excited, but above all, really proud that you're making this possible and all this content accessible to so many people. And I really can't wait to see it go live in a couple weeks. Thank you, Wendy.
Thank you, Joao. Thanks for great questions, and thanks for your support to this initiative.
Thank you to our audience.
Thank you. Thank you so much, Nick and Joao, for your highly engaging and informative session. And to our participants, thank you for your great questions and thoughts. Please note the session recording will be made available 24 to 48 hours after this session is complete. As Nick and Joao mentioned, if you are looking to continue this discussion in more depth and would like the opportunity to hear from more of Wharton Finance's thought leaders, the Wharton on the Markets program registration is open and dates are set for June 15th through July 22nd. Visit whartonexecutiveedlive.com for more details. And finally, please join us on Tuesday, June 2nd for our next session with Professor Maro Guillen, addressing technology and the pandemic. Once again, on behalf of Wharton Executive Education, thank you for joining us. Please stay safe, and we do hope to see you at Wharton soon. Thanks and have a great day.